Hey everybody, Stewart Heath here, CEO and founder of Harvard Grace Capital, with another episode in our series, 100 Questions You Should Be Asking Your Passive Activity Sponsor. We're in the section of questions right now of questions you should be asking about the investment itself. And so we've already had a big section of questions you should ask the sponsor about the sponsor themselves. Right now we're doing questions about the investment. Got 3 questions today we want to cover. This is the 6th episode in this particular series about the investment. So our first question for today is, how is the capital stack divided among senior debt, mezz debt, or preferred? So generally in a real estate deal you can have those 3 classes. Senior debt is the lead lender. It's where you get your best rate. It's going to be somewhere between 60 and 80% of the project, loan to value as they call it. You can have a piece that's more like debt. It might have some equity components. It's called mezzanine debt or mezz debt. Sometimes it's called preferred equity. And then the last class will be straight equity. They're the ones that last get paid. Generally, if things go well, they make more money than everybody else. Typically, you want to, depending if this is a stabilized project or if it's some sort of a rehab or development project, you're going to see senior debt around 50 to 60%, and mezz debt maybe another 20%, preferred equity, that kind of thing. And you want to understand the terms on each of those. A lot of times these preferred equity mezz guys, they're kind of wanting to. They're like vulture capital. They kind of want to swoop in and take the project if the sponsor stubs their toe, and then wipe out the equity players and take out the senior debt, and then they end up with a great project. So you gotta understand those terms. The second question for today is, who's personally guaranteeing the senior debt, and what kind of recourse is involved? We typically do that because our stabilized deals you work better with lower interest rates, and a loan a loan with a lower interest rate will make the economics better on a thinner margin deal. We like those lower rate, long-term fixed rates kind of thing. But who's sponsoring? If the sponsor is strong enough to be the guarantor of the debt, then he's pretty substantial and probably had some success. But you want to understand these questions. Last question for today is, in their modeling, what vacancy did they budget on? If they're up there at 99, in the high 90s of a percent of vacancy, you might want to take a step back and reevaluate. You need to look at vacancy in the market level and in the neighborhood level, and you should never expect more than just market level vacancy, because a lot of times vacancy is driven by all kinds of things, but the biggest factor will be what's going on in that particular market. Vacancy will also be driven by rate, and if your units are going to come out of the ground or as rehabilitated higher than everybody else in the market, they might not be gobbled up as quick as you think. And any kind of a model that is highly dependent upon high occupancy rates, really, really high occupancy rates, that model is probably going to have a little bit of trouble. So thanks for watching. Be sure and check back next time.